So good afternoon. We will get started, assuming that we'll have some more folks that are going to come in and join this live. So whether you're watching this live or on a recorded version sometime in the future, we want to say thank you for taking, the time out of your day to get some insights from your team here at Granite Bridge Wealth Management. This is our sixth webinar of 2025, and fulfilling our promise to all of our clients and friends and followers to deliver information that we hope helps you become better prepared for your today and also for your tomorrow. Today's topic, we're going to be talking about Social Security. Starting with just a little bit of the basics of Social Security. Sometimes, it's good to know, how did this all start? What was it originally intended for? And then how is it adapted to the way that we use it today? Also walking quickly through the claiming age options. So when can we start? What does it mean for us if we were to defer? And what are ideal scenarios for starting Social Security? Also, some key considerations. What do we believe as financial planners should go into making that decision on when and how to collect, especially if we're working with our spouses? Do we get it at the same time? Do we defer one? All those types of things. We're going to talk about the ingredients that we think go into good decision making around taking your Social Security benefit. More and more often, what we're seeing is that while a lot of people that are retiring from their careers are continuing to work in some aspects, even beyond their highest earning years or pre-retirement years, they're going and doing part-time work or doing consultative work. So how does that earned income collectively work with if we're also collecting Social Security, talking a little bit about the work income versus the Social Security income and how they collaborate? That will kind of lead us into the direction of tax consequences. What happens with Social Security as it is now a taxable benefit? And then the most important topic, which we write at the end, will be how do we really make sure that your Social Security benefit is taking into account some of the other income streams that you may have in the beginning, middle, and end of your retirement to make sure that you're really collecting as efficiently as you possibly can. So with that, we probably plan on spending 20, 22 minutes together today. If you do have questions, if you're a live viewer of this, you can put those into the chat feature and we'll be more than happy to address them at the end. And as always, if you do have questions that are more personal that you don't necessarily want to ask in this setting, please feel free to reach out to us at sayhello@granitebridgewealth.com, and we'll reach out to you so we can spend some time getting to know you and address whatever conversations that we need to together. So let's get into it. Social Security, let's talk a little bit of a history of it, was first introduced as a concept in 1935, right? As a way that we can help folks that are going into retirement years create some supplemental income for you. The first Social Security tax that was collected through FICA was in 1937. So it took about 2 years for the system to really get up and running. And then in 1940, just 3 years later, is when the first Social Security check was actually paid out. The first benefit collected in 1940. And Social Security, right from the beginning, has always been kind of paid for or collected through FICA taxes, so through our payroll taxes. So for some of you who might be federal employees, depending on which bureau you work for, you may not have ever paid into the FICA system, and maybe you're getting a federal pension and you're not eligible for Social Security. And really that's why, because there was no FICA tax in your end. For the rest of us who worked in the private sector or even some different governmental jobs, you will be a beneficiary of Social Security because you've paid your FICA taxes along the way. Initially, the way that this was set up, the Social Security system it was never intended to be the sole source or the major source of retirement income. It was really to be something that was supplemental for pensions back then, but probably in today's circumstances, supplemental to what you've been able to save on your own through 401ks, IRAs, and other tax vehicles. So while it does play, I'd say, a significant portion or significant role in retirement planning, it was really meant to be a supplement to things that we were preparing either on our own or through our employers. And this is the bitter part. This is probably the most bitter part of my presentation. when Social Security was originally introduced, it was a tax-free benefit. So when you got those Social Security statements every single month, and when you looked at it online, that number, if it said, "Hey, you're entitled to $3,500," at one point in time, believe it or not, that was supposed to be completely tax-free. And it really wasn't until 1984 that Social Security benefits across the board became taxable to Americans. If you think about this time, this is when we started this kind of bad process of the governments being in way too much debt. IRS and Social Security systems needed to figure out a way to help pay down that debt. And one of the easiest ways, the cherry picking idea, was let's make this benefit that was once tax free taxable to folks that are collecting. And so that's the way it is now. Obviously, we know there's a lot of conversations and news headlines around the potential of making Social Security tax free again. But truth be told, we're going to have to wait. Proof will be in the pudding in the months and years to come. So who's eligible for collecting Social Security? Well, first, we must have about 10 years of work, but it's not really 10 years. It's actually 40 credits. And we get a credit for every quarter that we work. So for every 3-month period that we pay into FICA, that we're collecting paychecks and paying payroll taxes, we get a single credit. And those of us who have 10 years collectively or 40 quarters collectively banked in the Social Security system become eligible for taking Social Security. So that's kind of the first piece of the algorithm and how they calculate what our benefit is. For most of us, the earliest time that we can start collecting our Social Security retirement benefit is 62. And we can take it anytime thereafter. So a lot of people say, do I have to wait for my birthday? Does it have to be on a certain anniversary? You can collect at any time starting on your 62nd birthday all the way up until the time that you turn 70. At least that's the way the system is set up currently. This may change. There's lots of talks about that as well. But earliest we can collect is 62. The latest that we're allowed to collect is at 70. If we wait until 70, it's automatic enrollment, and they will begin to send that benefit out to us. Each year that we defer that, obviously, the amount that is due to us on a monthly and annual basis becomes bigger. So if you think about Social Security, the longer you don't take from the balloon, the larger the balloon gets. So there's more air in that balloon. There's more available balance for you as an individual. And deferring each year is somewhere between a 7 and 8% gain every single year. So we'll get into a little bit more about when we think it makes sense for deferring it and when we actually think it makes sense for collecting early. But these are the basic ingredients that go into your Social Security benefit. And obviously, if you are 40 credits or 40 quarters, earnings play a part of that too. So they're going to use your top 40 credits when calculating your benefit. So if you had the kind of low income earning years in the beginning of your career and then somewhere mid to later career earning more, those 40 credits from those higher earning years are the ones that they use for calculating your benefit. So let's talk a little bit about those ages, right? At 62, as I mentioned, it's the first time. So on your 62nd birthday, if you want to or need to, you can start collecting from Social Security. There's a lot that we need to be careful there, though, because if we're still working and we're 62 and we're not yet at what they refer to as FRA or full retirement age, that benefit is reduced greatly. I'll get into that in a future slide. But if you are at age 62, yes, you're eligible, but what you're actually going to collect, and if you're still working, is going to be a big time shrunk. I mean, you are going to shrink your benefit by collecting 62 if you're still working. Some people need to do that. So if it is circumstantial, maybe you do that, but it's just good to know the rules and how it's going to be affected. Full retirement age for most people who are considering taking Social Security. So if you're kind of within like a 3 to 5 year window of your eligibility, your full retirement age is going to be somewhere around 66 or 67. For most folks right now, it's 66 and 2/3, oddly enough, is what they refer to as FRA on your Social Security estimates. It's that time and thereafter that your earned wages do not minimize your benefit. So I'll say that again. If you're working and you're full retirement age, let's call that 67, it's at that point that you can actually collect Social Security and they're not going to reduce your benefit based on your earnings from your employer. Prior to being full retirement age, it will be a reduced benefit based on your earnings from your employer. Don't mistake this for saying that this won't be taxable. Social Security is going to be taxable in either set of these circumstances. It's just that your benefit's not going to be penalized or reduced from your earnings or your wages after your full retirement age. Before full retirement age, it certainly will be. We're allowed to delay, as I said a few moments ago, up to age 70. So if you're someone who's fortunate enough that says, I don't need my Social Security, I have a long longevity, a family history of living well into our 90s, those types of scenarios, for some folks, it makes sense to defer to 70 because each year you're getting an 8% raise by not collecting. Again, that's not a recommendation. I don't know anyone who's watching this well enough to give that as a recommendation. Just saying, those are kind of the considerations that we put in when we're thinking about, do we take now or do we wait later? Let's talk about longevity. Let's talk about your financial need and your personalized situation. But these are the parameters around claiming ages and when those benefits can come due. Obviously, at age 62, your benefit is much less than waiting to age 70. That alone doesn't mean that you should wait until 70. You should really look at your circumstances. We can help a little bit with that. We'll talk about that in a few minutes. How do we go and analyze this decision? Well, one of the tools that we have at our disclosure is our financial planning software, where we're actually going to take your real numbers, the numbers that are on your Social Security estimates, whether it's online or the ones that are sent to you once a year. We're going to take those numbers and we're going to bring it into your life. And we will actually be able to compare at different ages what your annual benefit would be and your spouse, right? So what am I entitled to at 62 versus at 70? That's going to be your annual benefit and kind of how we are going to assess it on an annual basis. And then we're going to take a look at cumulative benefits, right? Because a lot of people say, I just want to see how much I can get out of the system. It's really important to me that I get as much out of the system as possible. Some people don't care, but if we are looking at it from that perspective, we're going to run the assumption that you're going to live until you're age 90. So if we were to collect at 62 and pass away on our 90th birthday, we're going to collect $850,000 in this set of circumstances over those years that we're collecting. If we defer to age 70 and we live to our 90, we're going to collect just about 1.1 million. So we can take a look at it on an annual benefits perspective, if that comes into play during your decision making, or how do we get the most out of the system over the remainder of our lives. For most people, we're going to be able to see, and we're going to create this uniquely on your life and your set of circumstances. So this isn't like a cookie cutter. This is pretty exact science, and we'll use your numbers to determine it. But we can find out based on your longevity, at least from a numerical standpoint, from a financial standpoint, when it makes the most sense. Again, what this part, this strategy summary at the bottom, what it doesn't account for are your personal sets of circumstances. Do you need it now? Do you have a health event? The system doesn't necessarily know about those. So while this is a portion of the data that we use to help our clients and guide them towards picking the right age, this is not an end all be all. It is certainly not that easy. But this is a really good way, from at least from a financial or numerical perspective, to really weigh the decision and see where the benefits fall and just what financial benefit you may receive if you do defer a year or two or all the way until 70. Really good. We'll be able to really bring this to an exact science using your numbers. If this is an analysis that you want us to perform for your family, happy to do it. Key considerations. So how do we determine it? If it's not just financial, Brian, how do we actually determine when and how best to start our Social Security income streams? Well, one, let's take a look at your longevity, right? If you're someone who's 65 and has been diagnosed with some type of illness that is very likely to mitigate your long-term retirement, well, maybe it makes sense to turn it on now versus waiting later. If you have a family health history where people don't necessarily live into their 80s and 90s, maybe that's something that we should consider during those lifetime, during this decision. How about this? What other income streams do you have available to you, right? If you have pensions and you're lucky to receive a recipient of a pension plan, and you have investments and maybe you're going to do some part-time work, do you actually need the benefit, or do you want it, right? It could be a need-based, hey, I need it to be able to pay my bills and maintain my lifestyle. It can be a want-based, hey, I'm doing all these things. I'm collecting a pension and I have part-time work income, but I would love to have my Social Security benefit to kind of just bank on the side and add to my investments. There's a lot of reasons why you may or may not want to do it during that time. We're going to take a look at the tax consequences of the combination of your pension and investments and part-time work before we make that decision also. Here's another thing, right, where we're really coming into as more and more families have dual incomes or dual career spouses, we need to take into account who gets what when. Is there big age gaps between our spouses? Are we retiring in sync or are we going to be retiring at different times? Does it make sense for us to evaluate starting my spouse's before mine and defer mine? All of these things should come in. So it's not just a, hey, I've gotten to a certain age or I've gotten to a certain place in my time, I'm just going to turn it on. These are the types of things that we really do suggest accounting for when you're making this decision because Social Security's changed. Once we start it, we can't necessarily modify it. We used to be able to do that. But now, once we start it, we're kind of committed to it through the rest of our days. And we want to make sure that our clients, if it's something you're going to do once, that you do it right. Spousal benefits. So let's go to my scenario of dual working spouses. If you and your spouse are earning the same wages forever and all have long-winded careers, this probably isn't at play for you. But if you have the type of spousal relationship where maybe one person didn't work or didn't have the full 40 quarters into the system, that spouse still has the ability to collect 50% of the spouse who does have those high quarters, that had paid into the system. So this is not a system if you're married that if you do not put in that you never get to collect. If you're married, you actually get 50% of your spouses and your spouse gets theirs. When your spouse passes away, that higher income, and now you're a widow or a widower, people go, well, isn't that just going to change and be so disruptive? It may be for a lot of reasons, but from a Social Security's perspective, you're either going to continue to be able to collect yours or your spouse's at time of passing, whichever one is higher. And so it's really not an or, you just go to the higher one. Depending on if it's your personal benefit or your spouse's, you're going to be able to choose which is going to be the higher. Interesting thing about our society is we do have folks that have been married several times. And so every spouse that we have that we were married to for more than 10 years, even our exes, can use our Social Security benefit or half of it. So if we have three spouses that we were each married to, let's say for 11 years, they each are entitled to 50% of our benefit for the duration of their lives. So it's probably a little bit too sweet, but it is there to support people who need it. If you're left wondering why the Social Security system is broken or underfunded, it's because a lot of these lesser known benefits that are out there. And it's not my opinion that these are bad or that they shouldn't be this way, but there's a lot of pressure on the Social Security system to take care of a lot of people, especially as our population is growing and circumstances inside family dynamics are changing. There is a lot of benefit that a single contributor to the FICA system can have on a lot of other folks. Again, I'm indifferent to that. It's just the way that it works. But you should know that if you are someone who is divorced, and you had a partner who you're married to for more than 10 years and you're thinking about how best to coordinate your Social Security, it's also really good to reach out to the Social Security Administration and see what other benefits that may be available to you. Worth exploring. All right, so let's talk a little bit about taxes. This is, or the penalties, sorry. A few minutes ago, I was speaking about what happens if you were to earn income from employment and also collect Social Security. So we're working. Let's talk about before full retirement age or FRA. So if you're let's just call it 67, and you're still working and you collect Social Security, you can earn up to $22,000 a year without any type of penalty whatsoever. After that, for every $1 that for every $2 that you earn over 22,000, your Social Security benefit is reduced by $1. So I'll give you an example. If you earn $22,320, nothing, no minimization of your Social Security at all. If you earn $22,322, you have $1 less in Social Security. For every $2 that you earn over that threshold, your Social Security benefit is reduced by $1. It's also taxed. So you have a reduction and it's also taxed. Really good to know, because a lot of people go, well, why wouldn't I kind of double dip? I'll earn from my employer and I'll turn on this benefit. If you're pre-67, that doesn't work as advantageously as initially expected for a lot of folks. When does that change? Because it does. At full retirement age, right? So maybe that's 67, maybe 66 and a half, whatever it may be for you personally. Now we have a higher limit at $59,520. Now we only have a $1 reduction for every $3 that we earn over that threshold. So it starts at 59,520. All you can collect Social Security and earn less than that, no problem, no reduction. But if you earn over that $59,520, it's reduced by $1 for every $3 you earn over it. So a little bit complex. After we, sorry, after we delay, we can actually go and have no limits, right? So if we're 70 and we're still working, you have no limits. You have full access to all the earned wages that you want and your Social Security without any type of penalty. Again, I don't want you to get this mistaken with. Penalty doesn't mean taxes. Social Security is going to be taxed in all three scenarios, right? But it's not going to be penalized or reduced as a result of earned wages. So really good to know, because countless times throughout the year, we have folks that will call us and they'll be 63 or 64 and they'll say, Brian, I have the best plan. I'm going to work and collect wages from my employer. I'm also going to turn on Social Security and just bank that $30,000 or $40,000. And while it sounds too good to be true, it's because it is. Your benefit's going to be reduced. It's not nearly going to be as advantageous a lot of times, unless it's a necessity and worth evaluating. Let's talk about the taxation, right? This is the fun topic. That's why we kind of have this guy who's bummed out here. This is confusing, and I personally believes that this system is confusing on purpose. It was designed to be that way. So this is the only income source that has kind of like two different systems that tax it. First of all, at the top line, it says 85% of your benefits can be taxable. That does not mean that it's at an 85% tax rate. It just means if you're collecting, let's say $1,000 a year, $850 of that is taxable. And that's not the tax rate. The tax rate is going to really depend on single or married and what your other income streams look like, right? So if we take a look at someone who is single, if they're earning between $25,000 and $34,000 cumulatively from all other income sources, 50% or so, or up to 50% of it is going to be taxable. So on $1,000, if you're earning in this circumstance 30 grand, your $1,000 of Social Security, 50% of it's taxable in your tax bracket. If we're married, those thresholds are obviously a little bit higher, right? Everybody that has over $44,000 in earnings, 85% of your Social Security benefit is going to be taxed. 85 is taxed, not at the 85% tax bracket, but 85% of it is taxed. I skipped over these because this is most people. Most people who are married, entering in retirement, are going to have more than $44,000 in earnings, whether it come from distributions or pensions or investments or rental properties or employment or whatever it is. So most people, 85% of your benefit is taxed, at least in our client base. That's the way it works. That's news to a lot of people. It's disappointing. Makes an even more powerful argument that if Social Security were to become tax-free, how much simpler does that make the tax code? So our fingers are crossed for everybody who is collecting and will collect, that we do see the system change back to what it was originally intended and being a tax-free benefit. This is complicated. This is worth evaluating. We have the tools to help you do this, so we can actually plug in your real numbers and figure out how much, if at all, your Social Security is going to be taxable. So when you're making this decision, you have a real understanding of what does that monthly benefit, annual benefit look like for you and your family. This is kind of where I'll wrap up, because I promised to keep this rather short today, but I wanted to give you enough information to at least get you thinking about this. When you work with our financial planning team, any of our advisors at Granite Bridge Wealth Management, we're going to take a look at kind of your whole picture, right? As I hope you've gotten to know, we really firmly believe that you shouldn't make a Social Security benefit selection in a vacuum chamber. It should really be considered amongst all of the other things that you have going on in your financial picture. Your IRAs that you may have, your 401k balances, if you have annuities and pensions and other income streams. We really want to make sure we can coordinate that. We do this through our financial planning tool. So if we know that we have a need for a family of $100,000 a year in retirement, let's just use a round number. Well, how do we best and most efficiently get you there? Is it starting Social Security early and using some of the investments in pension? Is it deferring Social Security? Is it deferring some of those other benefits? Really, these are personalized decisions. All too often, publications, I see this all the time in like AARP, in Money Magazine. They give these broad stroke recommendations on when and how best to address this. I don't believe in any of those. The collective intelligence at Granite Bridge Wealth Management really has proven that this is a very personalized decision, and we want to make sure that it's coordinated with everything else that you're doing. This is not a simple task to do on your own. This isn't something that you can do on a legal pad, or probably not even in like an advanced Excel. We really need the financial planning software to be able to accommodate for tax consequences, tax changes, and some of your more personal stuff. What's your health scenario look like? What are our life expectancies? All of that. So if you're looking to make an informed decision about Social Security, and whether that's this year or 5 years out, it's a good time to start kind of thinking about it, allowing us to draw up some of these scenarios. So when it is time for you to start your selection, you do so with total confidence. Next day, next year, 5 years down the road, you're not looking back and wondering if you had done it right, because we're going to take a thorough look at it and make sure that it is right for you personally. And our team is all equipped to do that. So our final takeaways, if you can take away anything from the 26 minutes or so that we spent together today, timing matters, right? You have an 8-year period where you're allowed to start taking Social Security to when you're forced to take it. It really does matter when you take it, because not only does your benefit go up, but it also might be taxable. You might be able to collect more later. You may have some advantages to your spouse if you were to defer, and it's worth taking a look at it. Timing does matter. It shouldn't just be one of those things like, oh, I got to a certain age where I always had it programmed that I was going to collect, and now I'm going to. A little bit more thorough analysis, at least we think, is worthwhile. Consider your spouse, right? We can really coordinate these pretty well. We can hedge some of our bets by starting somebody a little bit earlier and deferring the other spouse if we want to play that game. We want to know when and how your family is receiving income, because one of the things that I didn't mention is spousal income does not lower your benefit. It would be your personal earnings on your Social Security number. So again, if you're not understanding that, just another reason why a thorough analysis on this really does need to be put in place if you want to be confident in this decision. Taxes and income come into play. They sure do. They can change the game on the way that we collect. It can greatly reduce the benefit. We can see a number on the page on our Social Security estimates, and then when it hits our bank account, if we don't time it right, it can look very different. And we don't want you to be stuck with the decision that you make, because we're not able to do a reversal in a lot of these decisions. And so again, it's a key piece of retirement income, but it should also be a supplemental piece, in our opinion, working together with the other assets, the other savings vehicles, the other income streams that you may have available to you. So again, our goal with these webinars, and also just with working with our clients, is to give our clients unmatched confidence for their future, knowing that they looked at a decision as thoroughly as possible before they actually started it. Whether that's something simple like putting stocks in your portfolio, or something more complicated like picking your retirement date. We want to be your planning partner. We have the tools, we have the knowledge, and the experience to certainly help you with that. What you can count on through the rest of 2025 is, if you want more information on Social Security, it's as easy as giving our office a call at 973-559-5995. We're happy to coordinate you meeting with one of our advisors. You can also shoot us an email at sayhello@granitebridgewealth.com. It is now June. We've made it through 6 of our educational webinars on a monthly basis. We're going to have 6 more in store for you. And again, Social Security, not all that exciting of a topic, but also something that we think is critically important. We will have some more exciting topics as it comes through the rest of the year. We can't wait for you to join us. Again, whether you're live or on a recorded version of this, we thank you for your time, and you can count us being here for you and your families well into the future. So from all of us at Granite Bridge Wealth Management, we hope that you have a wonderful start to your summer. We hope that you stay safe and healthy, and we look forward to being your financial planning partner in the future. Take care.